Welcome back to part 4 of our series on Africa. So in the previous 3 sessions, we've been through understanding, or the need to understand that countries in Africa split into at least 4 groups according to their economic situation, and that's primarily driven by liquidity. So we spent some time in section 2 talking about liquidity, recognizing that if we get money out, it's got to get in the first place. Section 3, we went through talking about the benefits of having an onshore structure, recognizing that while most corporates prefer to be offshore, there are real benefits of having somebody locally who understands the market and has all the contacts. In this session, we're going to go through and say, okay, if you've been through all of this, you understand where the cash is coming from, you understand how the country works, and you may have taken the decision to set up an onshore presence. What are the things that you then need to do to make sure that you are now prepared to handle all the curveballs and all the other nice things that life in Africa will inevitably throw at you? The next session after this will be assuming that you don't do all of this properly, you're still going to have problems. So how do you manage that? But this one is going to be about what should you do to be properly positioned. And so with that, Michele, again, thank you for your time and look forward to hearing how you should manage a strategic African treasury.
Okay, thank you for that, Damien. Well, this is where the rubber really hits the road, and the idea is managing liquidity is about anticipating and organizing yourself in a way that reduces the risks of illiquidity. And there's some things that a company can do, and they have control over. But I think the most important aspect of managing liquidity risks is selecting the right banking partner in the country. And the reason why that is critical is that, and I notice I said banking partner, not bank. The idea is that, first of all, in liquidity crises, when there is a shortage of liquidity, what happens is it turns from being a buyer's market, i.e. the buyer being the client, into a seller's market, because the liquidity is concentrated in the hands of the banks. And therefore, it is critical that you are a client, that a company is deemed to be an important and valued client of the bank with a partnership and a relationship, because in the allocation of the scarce liquidity, those banking partners, and particularly those particularly where clients have multi-country presences, they will tend to receive the lion's share of that liquidity. So that's very important. The second thing, when illiquidity hits, the interbank market dries up completely. And therefore, what liquidity is available to corporates is the liquidity that a bank is able to get from its own internal market. And therefore, it is very important that you select a bank that actually has access to the inflows. So, for example, in Angola, right, actually, what happened is when there was a lack of liquidity, what happened is that clients opened accounts with every bank because there was scarce liquidity and they were trying to access the liquidity of every small bank. But then when they liberalized the foreign exchange market, and now the flows were concentrated in the hands not of the central bank, but in the hands of the international oil companies, banks that have access to the international oil flows are the ones that have liquidity for clients. And what they will do, they will allocate that liquidity internally to their clients before they do to the interbank. So the first thing, Damien, choose the right banking partner in the country. Once you've done that, we strongly recommend that people project their cash needs as far out as they're able to do, so that they are able to determine what is the quantum of liquidity risk that they are facing. And then with those projections, then also develop hedging strategies. Because remember, hedging, people regard hedging, they think in a developed world, I'm hedging against currency risk. In Africa, the currency risk is bordering on secondary. What really matters is liquidity risk. And hedging strategies and the use of derivatives to lock in liquidity in the future is critical. Now, Damien, you'll say to me, yes, this is all very well, but hedging, it costs money. And just as we said about what is the appropriate exchange rate to value the cost of sales, you have to recognize that minimizing liquidity risk actually has consequential cost, and those are the cost of doing business in a particular country, and therefore you do need to take those things into account. And there are plenty of derivative products actually available. They range from your normal FX forwards. There are FX swaps that allow you to basically raise liquidity in hard currency if necessary. There are obviously deliverable FX options. And finally, an interesting product that people should consider is convertibility options, because they are traditionally cheaper than an FX option because they protect you not for the currency risk, but they protect you only for the liquidity risk. And that is a product that is worth exploring. Finally, when all these things fail and you still end up with illiquidity, then the key is to make sure that you retain spare bank line capacity, because in the short term, when you have maturing LCs that need to be settled, then being able to borrow from the local bank in hard currency in order to settle your LCs is a way of making sure that you don't default on any of your obligations. And then what you can do is you can use the other derivative products in order to retire those bank lines. But most important thing, and maybe we can address that a little bit later in this session, is really is reading the liquidity tea leaves, and what are the early warning signs that you can use in order to prevent yourself from getting trapped. But before that, Damien, is there anything to expand on the previous points?
Well, I think those are truly enlightening and fascinating. For me, the obvious comment, and I'm sure this will be what many corporate treasurers listening will be thinking. First of all, in many cases, corporate policies, corporate treasury policies don't enable you to use a lot of these uh, derivative tools. So again, you're back to how would you recommend managing the reluctance to do this and the need to control it. Second is, again, I assume that these products are available in some currencies, but not all.
Yes, that is correct. I mean, and I guess it's the usual problem. We're talking of a continent where there are 20 to 25 countries that are of great interest, and unfortunately, regulations are not consistent. So, for example, at the moment, forwards are not available in Angola, except when they're sold by the central bank, whereas forwards are available in Tanzania and in Uganda. So you do have to manage that, and in some places it is impossible to use derivative products. It is a fact. It is a fact. Although one of the interesting aspects of this is that the markets are evolving. And therefore, over time, you are finding increasing adoption of products. So, when we were involved in Ghana 12 to 13 years ago, there weren't forwards in Ghana. And then over time, forwards became available. So it is the nature of these markets, hopefully, as they move forward, that more products become available.
Okay, and can I take something from what you said and suggest that participants or people listening think about this, which is that given the volatile nature of many African countries, you are going to go through periods of liquidity drought where it's just not going to be possible. So would it be fair to say that it's very important to educate management and to educate the business on this so that it's not a huge surprise when it happens?
Yeah, absolutely. And, that's something that I spend a lot of time doing. It is about education. And, and we have observed a number of corporate treasuries have amended their policies around products in order to accommodate and to compensate and to deal with the problems of illiquidity, recognizing that if you don't do FX forwards, you are unable to be able to manage your liquidity risk. Therefore, having a very inflexible corporate policy on the subject is simply nonsensical if you want to operate in Africa.
which I think brings us back to one of the points that you made at the very beginning. So I interrupted you in full flow. I think you were going to go on to something else.
Well, I was going to say, it is possible to actually read the liquidity tea leaves. There are some very clear signs of when a country may be entering a period of illiquidity. And maybe I can just quickly talk through some of them. So the first thing, and I will do so by reference to a slide that is shown on the screen. But before going through the countries on the slide, I think the first thing is just look at your macroeconomic policies. And often you see countries getting themselves into trouble quite consistently and repeatedly because they operate pro-cyclical government policies. Boom, bust. And what happens is basically they borrow, they spend money, they create economic growth. Economic growth pulls in imports. It starts to create a current account deficit, and then investors lose confidence in the country. They start withdrawing their money, and before you know it, the country gets into trouble. And as I said, Ghana is a fine example of that. Kenya recently has also been behaving in a similar way to that. Obviously, looking at global risk off, and if you believe that there is a very meaningful global risk off, then look at the countries that are dependent on hot money and foreign portfolio flows. And again, I will reference that on the slide. Look at reserves as well. Early signs of stresses come when reserves start being depleted, as the central bank has to offset the imbalances between current and capital account. Look also at the Eurobond markets and the sovereign Eurobond pricing. Investors in Eurobonds, because they take no currency risk, they look purely at the credit risk of a particular country, and they are particularly long looking. They're able to see when things are beginning to change, and there were a lot of the signs of the recent stresses came out in the Eurobond market a while ago. And then look at also at seasonalities and make sure that you understand the seasonalities. And so the idea behind seasonalities is that when there is plentiful liquidity, use derivative products to secure the liquidity and then to push that liquidity out for when those seasonalities actually unwind and you are in a negative environment. And then finally, I think like everybody understands, we've got elections in Kenya, elections in Nigeria next February, elections in Angola this year. Whenever there are elections, the market gets nervous. And it doesn't make any sense to get caught out on illiquidity because there's elections and you didn't act prior to the elections. But using the slide that I have there, top left, there are two slides that refer to Uganda, and what they talk to is the first one is talking about government revenues, and what you can see is that Uganda is able to maintain and to grow its revenues, and as a result of this, it is able to actually manage its liquidity. Look also, the next slide next to it is its total debt service breakdown. So you can see that they have a reasonably stable environment, and as a result of which, whilst the currency is depreciating mildly, they don't have any liquidity problems in Uganda. Compare that the slides at the bottom, which are for Kenya. The one on the left is the current account, and obviously the grays being the deficit in the trade balance. And you can see there is a picture of a gradual deterioration. Those should be early warning red flags. What is going on in Kenya? Are they going to get into trouble? I'll just remind you, 6 months ago, you could buy dollars freely. You could hedge out all the way to 2 years in Kenya, and there was definitely signs that the stresses were building. Top right, I think you have Nigeria. And what you have is on the left side of the top right is the domestic debt held by foreigners. And looking at the gray bars, look at those spikes. It's telling you the extent to which foreign investors are funding the current account deficit in Nigeria. That is an early warning sign, particularly back towards the end of 2019. As money started going out, it was clear that Nigeria was going to get into problems. And then on the right hand side, you have fiscal deficit in Nigeria. Look at those bars getting further and further and further into deficit. So you could see the early warning signs, particularly in Nigeria, and that liquidity was going to start faltering. Then in Angola, so it's the bottom left, the second from the left, you can see current account developments. Look at the terms of trade favoring Angola from rising oil prices. So the trade balance is positive in Angola. Not surprisingly, the kwanza has appreciated 25%, and actually liquidity is plentiful in Angola. In fact, there was a time when the oil companies were struggling to sell their dollars because the country did not want any dollars. It had too many dollars circulating. Another country of reasonably good stability is Cote d'Ivoire. And you can see the trade balance in Cote d'Ivoire, which is the chart, which is second on the bottom, second from the right. You can see the gray line, which is a reasonably steady trade balance. And this is a country that, because it has a peg and low inflation, it doesn't have any trouble attracting foreign capital in order to fund its economy. And then finally, in Ghana, the bottom right. So Ghana again, boom to bust. You can see that every 3 to 4 years, you can see the fiscal balance going very, very negative, and you can see that really towards the end of 2020, you could see the fiscal balance in Ghana going negative again. There was a big jump in those years towards the end of 19 into 20. That was an early warning. And so, these are the kind of the things that you can look at in a country to determine and whether they're likely to get into liquidity problems.
Okay, thanks, Michael. I'm afraid this is fascinating, and so I think this is really where it comes down to what are the things to look out for? How can you tell whether you're headed for trouble? And the important thing in this is make sure that the business understands that trouble and Africa kind of go together. So make sure expectations are set appropriately, but then make sure that you're taking measures to try and avoid getting caught out. Because again, there's no excuse for getting caught out when you know it's going to happen, right?
Exactly.
So is that a reasonable summary? And by the way, one thing, despite my face, I was actually born in Africa, and it's good to hear you only saying nice things about Tanzania, which is where I came from. But that's not the main message. The main message is
Yeah.
it's important to understand that liquidity problems are going to happen and use the tools that are
Yeah.
available to predict them and manage them.
Yeah. And
Okay.
that's returning to the partnership, though, Damien. A partnership with a bank that exposes all this information to you and has the intelligence and has the insights and puts these ideas before you is very, very important. There's no reason why a bank shouldn't be able to do that.
And that's interesting because that typically isn't what people put in their RFPs, right?
Exactly.
So clear message, I think there is make sure that you look for this service and that you make sure it's part of what you demand. Okay, that's
Exactly.
great. So thank you very much for that. And again, very
Uh, Thank you, Damien, for listening.